So you're trying to get your head around cryptocurrency, right?
Yeah,
It kind of feels like you're swimming in this huge ocean of information, hype on one side, super technical stuff on the other.
totally.
You just want to know what's really going on. Well, that's exactly what we're going to try and do today.
Yeah, today we're doing a deep dive, looking at where crypto is now, but also, the history that got us here.
Right.
We've got some really interesting sources, a big white paper from Yale Law School, kind of looking at the legal and economic side.
Okay.
Then a study digging into who actually owns this stuff and why.
Hmm.
An analysis from CentAURwebTop University Reading about media and Bitcoin bubbles.
Oh, interesting.
And a look back at the first cryptocurrency spoiler.
Mm-hmm.
It wasn't Bitcoin, plus some pretty sharp skepticism from the early days.
Exactly. And our mission here, it's not to tell you what to think.
No.
It's more about pulling out the key ideas from all these different viewpoints. Legal, social, market stuff.
Yeah.
The whole picture.
Trying to get that multifaceted view.
Right. Okay, so let's unpack this. That Yale Law School paper first. It kind of jumps right in, questioning if crypto actually delivered on that early promise, being a mainstream payment alternative.
Yeah, that's a huge point they made. They break down the theory first, the whole peer-to-peer thing, cutting out banks and middlemen.
Right, the decentralization dream.
Exactly. It relies on those cryptographic keys, public and private and digital signatures. Your public key is like your account number you can share.
Okay.
Your private key is like your PIN. Super secret. Authorizes the transaction. That's the magic, supposedly. Allows transfers without a central... Okay.
Like Alice sending Bitcoin to Bob. She uses her private key to sign it, sends it to Bob's public key, and it gets logged on that public ledger.
Precisely. That's the theory.
But the paper says, well, theory is one thing, practice is another, especially for everyday spending. What are the big hurdles they point out?
Well, several things baked into the design. First, irreversibility.
Meaning, like, no takebacks.
Exactly. You mess up, send coins to the wrong address, get scammed.
Mm-hmm.
They're usually just gone. Unlike, your credit card where you might have some fraud protection.
Yeah, that's a big one.
And then there's volatility. I mean, it's kind of the elephant in the room, isn't it?
Totally.
I mean, imagine trying to buy, like, groceries or coffee when the price could crash or spike between putting in your cart and checking out. It's just not practical for day-to-day stuff.
No way. And then you mentioned fees earlier. People sometimes think crypto is cheap, but that's not always true, is it?
Not at all.
Yeah.
The Yale paper explains how networks like Bitcoin have this built-in limit on how many transactions fit in each block.
Right.
Bitcoin can only handle, maybe 3 to 7 transactions per second globally?
Wow, that's tiny compared to Visa or MasterCard.
Exactly. Visa does thousands. So when lots of people want to make transactions at once, it becomes like an option. You have to pay higher fees to get your transaction included quickly.
And those fees can get nuts, right? Like tens of dollars sometimes.
Oh, yeah. Paying $50 in fees for a $5 coffee, it doesn't work.
Definitely not. The paper even mentions El Salvador, making Bitcoin legal tender. That was supposed to be the big real-world test. How did that actually play out in terms of people using the blockchain day to day?
Well, ironically, not so much on the blockchain itself for most people. While businesses had to accept Bitcoin, the government rolled out this app, the Chivo wallet.
Okay.
And for most users, their Bitcoin transactions were basically happening inside Chivo's own system, like a regular digital wallet, not really hitting the main Bitcoin blockchain for every little purchase.
Huh. So it ended up being more centralized in practice.
Pretty much, yeah. For the everyday stuff. It
Yeah.
didn't really showcase that core decentralized promise for the average user.
Interesting. Okay, so if it's not really working for mainstream payments, what are the real-world uses, according to Yale? Besides just speculation, I mean.
Well, the paper does point to its use in facilitating illicit activities. Things like buying drugs on those darknet markets, like the Silk Road back in the day.
Right, that's always been part of the story.
Yeah, though they do note that even at their peak, those markets were still a pretty small slice of the overall illegal drug trade. So it wasn't like all illicit stuff moved to Bitcoin.
Gotcha. Okay, now let's talk about decentralization. That's like the central promise, isn't it? But the Yale paper questions how real that is.
It really does.
Yeah.
It asks, okay, where does the trust actually go? Because with systems like Bitcoin using proof of work,
The mining thing.
right, it uses a ton of energy.
Mm-hmm.
And that gives an advantage to big players, companies with access to cheap power and specialized hardware.
So it centralizes mining power.
Yeah, tends to. It concentrates in the hands of fewer, larger entities. And beyond mining, users still have to trust all these other actors, right?
Like wallet providers, exchanges.
Exactly. Wallet providers, the exchanges where you buy and sell, the developers writing the code, the miners confirming transactions. Arguably, you're trusting more parties, and they might be less accountable than, say, a regulated bank.
So the trust just shifts, it doesn't disappear.
That's the argument. And they point out that in many cryptos, a small group often holds enough voting power or influence to control things, which kind of undermines that whole truly distributed idea.
Okay. And what about smart contracts? Another huge buzzword.
Yeah, programmable money. Sounds great. The paper acknowledges the appeal, even points out, hey, the Vanguard 500 index fund from way back in '75 was kind of like programmed money following set rules.
Huh. Never thought of it that way.
But they highlight big practical problems with current smart contracts. Again, that irreversibility thing. If there's a bug in the code,
It can't be fixed easily.
often it can't be fixed at all on the blockchain. And that can lead to huge losses. They mentioned the parity wallet bug where millions in Ether got locked up permanently.
Right.
And they're vulnerable to hacks and exploits. They draw parallels between some of these DeFi yield farming things and, well, basically Ponzi schemes like the Anchor protocol on Luna that collapsed spectacularly.
Right, those DeFi blowups were massive. Okay, the paper also looks at DAOs, decentralized autonomous organizations. How do those stack up against, like, regular companies?
The analysis is interesting. They say, structurally, DAOs look a lot like old-school joint stock corporations,
Yeah,
just with different voting tech,
but without the rules.
often, yeah. Less regulatory oversight, fewer built-in investor protections. The tokens DAOs issue for voting, they basically function like securities, like shares.
So they should be treated like securities.
That's the argument. The paper suggests existing corporate and securities laws could and probably should apply.
Makes sense. And stablecoins, they're meant to solve the volatility problem,
You
right?
try to, yeah, by pegging their value to something like the US dollar.
Yeah.
But the Yale paper brings up this really interesting historical parallel
Oh, yeah.
to the free banking era in the US back in the 1800s. Before the Fed, lots of private banks issued their own banknotes, often without enough gold or whatever backing them up.
Wildcat banking.
Exactly. Lots of instability, bank runs, people losing their money. The paper raises concerns that some stablecoin issuers today, like Tether or Circle, could pose similar risks if not properly regulated and audited. Are the reserves really there?
Right. And concerns about money laundering, too, even if using them for general commerce is still a bit clunky.
Yeah, the conversion in and out of regular money is still a hurdle, but the potential is there. History suggests unregulated private money can be risky.
So, summing up the Yale perspective, what's their main takeaway on regulation?
The big one is focus on function, not just the fancy tech. Apply the duck test.
If it looks like a duck, swims like a duck.
It's probably a duck. If a crypto token acts like a security, regulate it like one. They argue many new coins already fit the existing Howey test for securities.
Okay.
And they say the SEC needs to be more proactive with exchanges, make it clear new tokens are generally securities, and definitely regulate stablecoins properly, maybe as money transmitters.
Wow, okay. That's a really thorough legal and economic critique. Now let's pivot. That second source, the PMC study from 2022, this one's about who actually owns crypto. It gets more into the social and psychological side, right?
Absolutely. This study surveyed, I think, over 2,000 American adults. Found about 30% said they owned some crypto back then.
30%, that's quite a lot.
It is. And interestingly, owners came from across the political spectrum. It kind of busted that myth that it's only one type of political group involved.
But they did find some common threads, right? Certain beliefs or personality traits.
Yes, they did find some statistically significant links. One was a correlation with believing a higher number of conspiracy theories. Another was a link to what psychologists call dark personality traits, things like narcissism, Machiavellianism, psychopathy, even sadism.
Whoa. Okay. That sounds intense.
It does. And they also found that crypto owners in their sample were more likely to use alternative or fringe social media, Reddit, Telegram, Truth Social, 8 blogs as their main news sources.
Interesting. So less mainstream media, more alternative platforms.
Seems to be a pattern, yeah. Kind of makes you wonder about that distrust of traditional institutions maybe feeding into both things.
Yeah, possibly. So when they crunched all the numbers, what were the strongest predictors of someone owning crypto?
In their model, being male was the strongest predictor.
Okay.
Also, relying on those alternative fringe social media sources for news was a big one. And interestingly, traits like argumentativeness and having an aversion to authoritarianism both right-wing and left-wing kinds, also showed up as significant predictors.
Huh. So not necessarily fitting neatly into left-right boxes on that point.
Right. And things like just using mainstream social media a lot, or the total number of conspiracy theories believed, those were only marginal predictors in the final model.
So if you had to sketch a rough profile based on this study.
Well, the study suggests someone who's more likely male, maybe slightly higher income, potentially feels a bit like life's unfair, or they're victimized by the system, and gets their news mainly from these less mainstream online places. The researchers kind of connected to broader anti-establishment feelings and maybe being drawn to non-normative behaviors.
That's fascinating. It adds a whole different layer to understanding who's drawn to this space, especially if, as the Yale paper argues, the mainstream payment use case is struggling.
Exactly. It suggests motivations might go beyond just pure utility or investment strategy for some owners.
Right. Okay, let's shift again. Source number 3, the CentAUR study on media coverage and Bitcoin bubbles. This gets into market psychology, right? How stories influence prices.
Precisely. They looked at a huge amount of Bitcoin news from Google News, like 2012 to 2021, and they used a statistical method to pinpoint when Bitcoin was likely in a price bubble.
And what did they find? Does media drive the bubbles?
Their findings really support that idea. They found that during bubble periods, media coverage, both positive and negative news, could actually predict Bitcoin's price returns.
So the hype or even the FUD actually moves the market during those frothy times.
Seems like it, yeah. It backs up what economists like Robert Shiller have said about narratives and social psychology being key drivers of asset bubbles.
And is it a one-way street, or does the price also affect the news?
It's definitely a feedback loop. They found that big price swings in Bitcoin, up or down, tended to predict how much media coverage there would be, both during bubbles and outside of them.
That makes sense. Price goes crazy, suddenly it's headline news everywhere.
Exactly. More clicks, more attention.
But did more news automatically mean more people started trading? What about trading volume?
That was interesting. During the bubble periods, they found basically no significant link between media coverage today and trading volume tomorrow.
Huh. So the news might fuel the feeling, but not necessarily immediate buy-sell actions during a bubble.
Perhaps. It might be more about reinforcing the existing mania or fear rather than triggering specific trades, though outside of bubbles, they actually found a negative relationship. More news linked to slightly less trading the next day, oddly enough.
Weird. And was this just a Bitcoin thing?
No, they found similar patterns for other big coins, like Ethereum and Litecoin, and even in non-English-speaking countries, and during the COVID pandemic.
Okay.
They also noted that during bubbles, the ratio of Bitcoin's price to its energy use was positively linked to news coverage. The big picture takeaway is that media outlets, competing for eyeballs, often end up amplifying price swings, which can feed into market irrationality and bubble formation.
Yeah, the story around the asset becomes almost as important as the asset itself, especially when things get speculative.
Absolutely.
Okay, history time now. Our next source from Investopedia looks at the origins, and it makes the point that Bitcoin, while obviously huge, wasn't actually the first digital currency attempt.
That's right. A common misconception. Investopedia points to eCash, developed way back in 1990 by David Chaum's company, DigiCash.
1990, wow, that's early.
Yeah, built on Chaum's 1983 paper about blind signatures for untraceable payments. That paper laid out a lot of the core crypto ideas we still talk about, especially privacy in digital transactions.
So eCash was aiming for anonymous digital cash.
Pretty much, yeah. Mimicking the privacy of physical cash online. Untraceability was a key goal.
Were there other important stepping stones before Bitcoin came along?
Definitely. Investopedia mentions e-gold from 1996, digital currency backed by gold, though it later got tangled up in illicit uses.
Okay.
Then there was B-money in the late 90s. That was a big influence, aiming for a decentralized system, and it was actually cited in the original Bitcoin white paper.
Ah, so a direct link there.
Yep. And Hashcash, also mid-90s, this introduced proof of work, making computers do hard work to prevent abuse.
Same concept Bitcoin uses for mining.
Exactly. Hashcash used it mainly to fight email spam and denial of service attacks. Bitcoin adapted it for its consensus. Hashcash had scaling issues, though, as computers got faster.
So yeah, crypto, as we know, it didn't just pop out of nowhere. It built on decades of ideas.
Over 2 decades of development, yeah. Lots of trial and error.
And, of course, we have to mention the first purchase with crypto.
Right, the legendary pizza purchase.
Yeah.
2010, someone paid 10,000 Bitcoin for 2 pizzas.
It's just mind-blowing to think about that value now.
Isn't it? Puts the whole speculative journey into perspective.
Okay, now for our final source, which offers a totally different vibe, the early skeptics. We looked at the r/Bitcoin subreddit, a place known for being critical from day one.
Yeah, our Bitcoin has been around a long time, basically serving as a hub for people who were, let's say, not drinking the crypto Kool-Aid. Looking back at their early posts is pretty revealing.
What were their main criticisms back then? Were they worried about the same stuff people talk about now?
A lot of it, yes. A huge recurring theme was the lack of real-world use cases beyond speculation or, crime.
Okay, the utility problem.
Right. They were questioning scalability early on. Could this stuff actually work for lots of people? They were skeptical about things like the Lightning Network even back then, pointing out its complexities like needing inbound capacity and still needing regular on-chain transactions.
So the technical hurdles.
Yeah. And there was just a strong, persistent feeling that it was all a bit of a scam, or like gambling where the house odds were hidden or rigged by exchanges.
That perception was there early.
Oh, yeah. The association with shady stuff, even before it hit the mainstream, definitely fueled that skepticism. Plus, just fundamental doubt about, magic internet money with no real regulation behind it.
Did they point to specific examples or experiences?
Well, things like unsustainable economics, like can a system really survive just on transaction fees long term? And personal stories started cropping up about failed or dodgy exchanges. Quadriga NCX is a famous later example, but there were earlier issues too that fed into the narrative.
Right, losing money on a shady exchange would definitely make you skeptical.
For sure. And just a general sense of financial common sense, a wariness about putting money into something so volatile and poorly understood. It's really striking how consistent that negative view has been in certain online finance circles from the very beginning.
It's a really valuable counter-narrative, isn't it? Shows that the doubts and the fundamental questions we're still discussing today were being raised right from the start.
Absolutely. It wasn't all just hype and techno-optimism. There were critical voices asking hard questions all along.
So, kind of bringing all these threads together, this deep dive, looking at the Yale legal economic critique, the study on who owns it, the media's role in bubbles, the actual history, and the early skepticism, it paints a really complex picture.
Definitely not simple.
We've seen these fundamental challenges for crypto as mainstream payments, irreversibility, volatility, scaling, fees. Regulation is still a huge question mark.
Yep.
We saw the owner profile is kind of interesting, linking to certain psychological traits, political views, and reliance on alternative media.
Right, the who and why beyond just finance.
And the media clearly plays a big role, maybe amplifying those speculative bubbles. History shows Bitcoin wasn't first, and skepticism isn't new either. Those core doubts about utility and viability were there from the start.
So yeah, despite all the talk of revolution, the path to mainstream payment use seems, well, pretty rocky based on these sources. The current strength looks more tied to speculation, maybe that anti-establishment appeal for some.
While the actual long-term utility might end up being more niche, or maybe under much stricter rules that learn from history's mistakes with unregulated money.
Exactly. Hopefully, pulling these different perspectives together gives you, the listener, a clearer, more digestible handle on this whole thing.
Yeah, we hope so. And maybe one final thought to leave you with. Given all these challenges, the tech hurdles, the speculation, the regulatory fog, what do you think the realistic future for digital currencies actually looks like? Is it really about replacing dollars and euros for everyday stuff? Or will it find its footing in other areas, maybe more specialized uses, where its unique features offer real value?
It's definitely something to mull over, thinking about all these different angles we've explored. We encourage you to keep questioning, keep learning, and form your own informed view as this whole space keeps changing so fast.